Hey, this is Bill Pinnell coming to you with Yousif Oraha, the founder and CEO of Phoenix Mortgage. How you doing, Yousif?
I'm doing great. Just another amazing day here in Michigan.
Oh, you gotta love Michigan summers.
Yes, amen. Amen. How are you doing?
Just great, just great, and it's great to see you and get. I wanted to get some thoughts from you on the mortgage process, and maybe you could tell us a little bit about your company. If you'd
Okay.
like to start off, just telling us a little bit about your company, and then we can take a look at some questions about in regards to getting a mortgage.
Yeah, absolutely. So after 3 years in the mortgage industry, I've always worked for brokers, which the difference between a broker and a lender is a broker is free to shop a loan around to multiple lenders. So a broker will sign up with multiple lenders, and based off of whatever a client wants to do, whether it's to purchase a home or refinance a home, you can tailor that loan to a homeowner better than one specific lender can. So we have access to many different programs, and one of the reasons that I wanted to really start, Phoenix Mortgage is, in the midst of this pandemic, I said, hey, what other time am I going to have to work on something from home for, months on end? And, I try taking the bad and turn it into a good. So we've been licensed in the state of Michigan as of June 26th. We are currently working on getting licensed in California, Virginia, and Pennsylvania, and hopefully just go from there.
Awesome, awesome, that's great. So that then will allow you not only work in Michigan, you'll be able to work in the other states, but also you have different types of loans that are available for people.
Absolutely. So, one of the questions you ask someone when they want to get pre-approved for the process is, are you a W-2 employee or are you a 1099 employee? And based off of, that, as well as, how long have you been at your job? What is your credit score? We're able to really, off the bat, kind of push your loan to where it's going to go to close. Some lenders are great at one program, not so great at another. And as a client, you're not going to really know that, unless you've gone through the mortgage process, a dozen times. But different lenders are going to have their different options, and it's pretty wild. There is a loan out there from anyone, for anyone. So whether you're a physician with a ton of student debt, whether you're a military vet with $0 in savings, and whether you're just a plain, an average Joe, there is a mortgage out there for you. So that's why I always recommend shop with a local broker. Brokers tend to have niche markets in the area, and they'll be able to better guide you to to get a rate. And a lot of people who sometimes I get on the phone with, they'll say, well, I've never heard of you. And I say, well, that's right. I don't have to spend millions of dollars on marketing and advertising every year. Hence, this is why we're going to be able to get you a better rate. We're a smaller local company, and we're growing organically. We're not trying to flood your inbox with emails and commercials on TVs. We're just trying to get you the best pricing to get you into your dream home.
Well, that's awesome because you keep that overhead cost down and you don't have to pass it on to your clients in that.
Exactly. And leading on to that, a lot of lenders that you work with, the first thing they're going to ask you is for a good faith deposit. They're going to ask you for a payment up front. They're going to ask you for a credit card to just begin the process. As brokers, I would say 99% of the ones I know, including myself, we do not collect any upfront fees. So we're not getting paid until you have the keys to your new home or your refinance is closing. So we are working purely off of getting your goals accomplished.
Okay. Now, would it cost me anything if I did not qualify for a mortgage?
It wouldn't. One of the biggest questions people ask is, if you run my credit,
Right.
you know, I don't want that score to go down. And I think, you know, that's one of those things that loan officers, unfortunately, for a long time has used as a tool to maybe not have their clients shop around their mortgage, and say, oh, you know, don't go get your credit pulled by another different companies while you're in process with me, which has some basis. You know, when you're in the process of refinancing or purchasing a home and you get your credit pulled, you don't want to go and shop around your car loan and go and you know, try and consolidate your Amex debt into your MasterCard you know, line of credit. So it doesn't really cost anything. Some lenders will choose to charge you a credit reporting fee. But, you know, honestly, you know, I don't even like doing that. Most people know approximately what their credit is. And, you know, if it's below a 620 right now, it's very difficult to get a mortgage. And the reason being is there's so much business right now that lenders can really increase their guidelines to who's eligible for a refinance, just to keep their workflow manageable. There's been times where, you know, we're not in a pandemic, and if you're at a 580 credit score, there is options and programs for you to get a home. But really, if you're below a 620, you know, I would say, you know, pump the brakes on trying to get a mortgage, and maybe pay off you know, some debts to get that score above a 620, and then you know, try again.
Okay. Okay. So you want to see him with at least a 620. And because I know everybody, I mean, the rates are so low right now, it's a great idea to be buying a new house or refinancing and stuff like that. But, you know, you want to make sure you do qualify for it. How much would you need for a down payment?
So depending on where you want to live, there is government grants and programs in certain counties and certain areas. If you're below a certain income limit, you know, you can put an asterisk next to how small the down payment you could bring, just based off of you know, government programs that are down payment assistance programs, where they grant you that money under the condition that you stay in said home X amount of years.
Okay.
For the average citizen who's not a military veteran, there's 1% down payment programs, and there's 3% down payment programs. So you know, let's say you're moving into a $200,000 home, you could bring $2,000 to $6,000 to closing, and you know, qualify for a mortgage. But also, you know, if you're a veteran, let's say, you can bring nothing to closing, realistically. So military veterans, you know, God bless them and thank them for their service. They are allowed more flexibility in terms of the programs and rates that are available to them, as well as the amount of money they would need to, you know, bring to a closing table. But 1% to 3% will usually be the smallest down payment you can bring. But a lot of people who don't want to pay mortgage insurance, which is different from homeowners insurance, are required to bring 20% of that home's value to closing if you don't want that mortgage insurance added monthly to your payment. I would say, you know, almost all millennials, you know, unless you're getting a gift from a family member or a friend, are bringing, you know, between 3% to 5%. 1% down payment programs are a little bit more rare, but you know, 5% is usually what we see. 3%, there's still loan programs for you, but 5% is a pretty safe figure.
Okay. And ideally, you'd want to have 20% if you don't want to do the mortgage insurance.
Not only for the mortgage insurance, but what I see a lot of is, you know, especially in this market where there's a small supply of homes available and there's such a high demand, you know, we're having, you know, I'm talking to realtors and they're saying we're having, you know, 15 offers on a home.
Right.
And if you're both offering the same price, but you're putting 20% down compared to someone else putting a 5% down payment, the buyer is, almost always going to go ahead and accept the offer with a higher down payment, because that's less money that you would need to qualify for through the mortgage company. So it varies, but in a competitive market, sometimes it makes sense to put more of a down payment, just because it's going to look like a more attractive offer than someone who's putting 1% or 3% down.
Okay. Yeah, that makes sense. Now, with the rates being so low, I don't know if it's as big a deal right now because they're not climbing, but can you do a rate lock, and does it cost anything to do that?
Great question. When you are purchasing or you are refinancing a home, it's not as if you can go ahead and lock in your interest rate before you found a home. So you have to start the mortgage process first and foremost by seeing how much you qualify for. And that starts with, what's your credit score? What are your incomes? And what are your debts? And, once the offer is accepted and your mortgage loan officer presents you financial documents, you have to sign to agree to get that interest rate locked in. Now, on the other hand, there is programs where, let's say you are paying a contractor to build a home, or said contractor is going to build that home for you, and then you're going to receive you're going to receive a mortgage later. You can lock in your interest rate for up to 270 days, which comes out to 9 months on a new built refinance. Okay. So you need to own the land. That's the first that's the first and foremost on that program to lock it for 270 days. But once you own the land, you can have a construction loan from a bank or a private investor, and that will allow you to start the mortgage process with a mortgage company, and therefore you can lock in for 270 days. Now, the kicker to that is whatever the origination fees are, and I could speak a little bit later of what origination is. Right. Those origination fees have to be paid up front when you are locking in your interest rate for 270 days on a new build. And that's not the majority of mortgages. The majority are just refinances and purchases, and you can lock it for up to 90 days with most lenders. But if your lender is taking 90 days to do your mortgage, it's probably red flags. Right. Brokers, they are usually able to work a little bit quicker, just because you're doing the A to Z on your end. You're not dealing with 4 or 5 different people working on your file in 4 or 5 different states. And some of the larger companies, that's exactly what happens, is they have a processing team in Michigan and sales team in Pennsylvania, and as you get to different steps of the process, you're constantly talking to someone differently. But most brokers, they're 1 to 10 employees. Whoever you started the process with is going to be there for you. You don't have to constantly re-explain yourself and go back and forth.
Okay. One thing I forgot to ask you about, because you brought up the build, and with me also being an investor, as far as a down payment for an investor loan, what do you look for that? Because generally it's going to be a little bit more.
It is. So for for investment homes that and lenders will constantly email me throughout the day and say, this program now available on investment homes. So just because someone might tell you, it's 5 or 10% that you need for your specific loan, that's not set in stone. Rates are changing. Investors are constantly coming out with new programs. But the last time I checked, 25% was really what they wanted for multi-tenant investment. That's
I think it just froze up on me.
Smaller.
It just froze up.
Okay. Where did it freeze?
You were talking about multi-tenant, the 25%.
Yeah. So duplexes, multi-tenants, 25% down is what it's at right now. But at the same time, there's different circumstances. If you wanted to do an investment property where you're rehabbing, They have different loan programs that can vary from 5% down to some programs in Detroit are you can get financing for almost nothing down
Okay.
if you meet those specific credentials.
Okay.
So that's why I always advise go with the brokers, because based on what you want to do, whether it's an investment property that's already occupied and you have tenants in there, 25% down. If you're doing some sort of investment property that no one lives there, depending on the county and where you're at, the down payments are really going to vary, as well as the financing guidelines.
Okay. Very good. Now, could you tell me the difference because like if we get a loan, the rate's at say 3.6%, but they say like the APR is 3.89%. What does that all mean for those that don't understand that?
Okay, so APR is your rate expressed as a cost. What that means is your origination fees, your discount points or lender credits, depending on what rate you choose. How does all that factor into what your APR is? So the interest rate is, if you're getting a 3% interest rate, let's say, and there is zero title fees, there's zero origination fees, there is no added charge, your APR is going to be a 3.001%, I believe, just because you're aggregating that number over the life of the loan. But the APR is it is always higher than the interest rate, because with every loan there is going to be closing costs. You need to have a title fee. So realistically speaking, it's more so has to do with what rate you're getting, plus the cost of it is going to be your APR. And APR, what I try to tell, what I try to educate clients on is that, don't so much focus on your APR, because no broker and no loan person knows how to calculate it. No one knows how to, I'll admit that no one knows how to calculate it. It's just, we focus and say, pay attention to your interest rate, and pay attention to your cost, obviously, but do that by looking at your loan estimate. And, I'm happy we're actually on this topic, because if I had 2 minutes to go on there on CNN or Fox and educate people about mortgages, I would say, the holy grail of your refinance or purchase is precisely your loan estimate. That is what you use to make sure that when you get to the closing table, what you were told, by your mortgage professional is what is being delivered. Obviously, road bumps happen. Things happen in the process where you might have to change the rate or extend the lock of your rate from 30 to 60 days, and that can affect your pricing. But I try to steer people away from, hey, don't focus so much on APR, which the guidelines from the National Mortgage Licensing System force us to disclose APR if someone closes you an interest rate. And most of the times they'll say roughly this is the APR, because again, the cost of origination can can vary, and that's going to affect your APR. So pay more so attention to what's the interest rate, is my rate locked, and if yes, how long is it locked for? And then, on that second page of that loan estimate, it'll have a breakdown for you of all of your fees, all of your costs. Are you receiving a lender credit, or are you, buying down the interest rate? And that way you really can compare apples to apples, because when you buy your home, the cost of the homeowner's insurance, the cost of the taxes, that's not in our hands. The only thing that is in our hands is what's your interest rate and what are the fees associated with that specific rate.
Okay. I had a thought when we were talking there, and it kind of went away from me, but let me see if I can come back to it. We were talking about, could you talk a little bit more about, the origination fee, the discount? How do I buy down my rate? What's all that about? Because it sounds kind of confusing for somebody just going in, buying their first home.
Sure. Absolutely. And you know, one of the biggest questions that I get from people is what's the lowest interest rate out there? What's the lowest rate I qualify for? And although low rates are going to have you pay less interest over the life of the loan, a higher interest rate is going to cost you less upfront. So if you're going to make a 3% down payment on a home, but it's kind of a tight squeeze, I would suggest to not get the lowest rate possible, because when I qualify someone, it gives me a rate sheet and it'll give me a range of different interest rates someone can qualify for. And it'll say the lowest rate you can qualify this person at is, let's say, a 3% interest rate. And the highest rate will be a 4.5% interest rate. At that 3% rate, you would have to bring an additional 2% of your loan amount to closing. So if you're putting 3% down, that's 3% down plus your origination fees, which in points alone, by law, you can pay up to 2% of your loan amount. You can't buy down the rate past 2%. And on the contrary to that, the largest lender credit you can receive is 2% of your loan amount. And what I mean by a lender credit is, let's say instead of taking this 3% rate and bringing an additional 2% to closing, you can realistically take the 4.5% rate. And if you were planning on bringing 3% to closing, now you would be bringing 1% of the loan amount. And what I mean by that is you are now able to receive a lender credit instead of buying down your rate. The lender is incentivizing you by giving you additional funds to help cover those costs of closing.
Okay.
So based on, whether, and sometimes it's not even a matter of how much money do you have? Do you want to buy it down? Or, if the down payment's going to be difficult, taking a higher rate, sometimes it's a matter of how long do you plan on living in the home for? It doesn't make sense to buy down your interest rate and pay extra points in origination if you plan on leaving that home in 1.5 to 2 years, because you'll never see the savings of that lower rate because of how much higher of a cost you paid. So, you can look at amortization schedules and your cost to recoup and decide, okay, if this is a home that I want to stay in for maybe 5 to 10 years, maybe take a middle rate. If this is my home that I plan on staying in for 30 years and never refinancing, go ahead and buy down the points and get the lowest rate possible. But if this is a home that in 2 to 3 years you plan on just fixing up and selling, or maybe renting it out, or whatever it may be, moving to a bigger home, and this is just a starter home, and you hope once you have kids to move on to a bigger home, I always say there's no point in paying down
right.
paying down for the lower rate when you can just put less money out of pocket, and you're going to be out of that home within 2-3 years anyway.
Then to follow up with that is, if I'm only going to be there, less than 5 years, am I better off? Because I know there are different terms that I can get, like for 15 years,
Yes.
20, 30, like what are different terms can you get a loan for? Is it just 15 and 30?
So back in like 60s, 70s, 80s, you can do a 50-year
Don't be bringing
mortgage.
my age into this.
But right now, to be a conforming loan, 8 to 30 years is usually the standard, and the 8-year programs are pretty rare, because that would mean you need an incredible amount of income to be able to document to be qualified for an 8-year mortgage. 8 years is 96 months. So if you have a $300,000 home, I mean, that's you're squeezing 30 years worth of payments into 8 years.
Wow.
And that can be extremely difficult. But 15 to 30 years, I would say, are 99% of the loans that we see. And you're bringing up great points here, Bill, because a lot of people are so fixated with the fact that I don't want a 30-year mortgage because I don't want to take 30 years to pay off this mortgage. And that's completely, completely a falsehood. If you're in a 30-year mortgage, you can always make an extra payment or pay the projected payment on a 15-year payment and still pay off that home in said amount of time. So if you have a 3% rate on a 30-year and a 3% rate on a 15-year, the only thing that 15-year does is it forces you to pay extra money every month to that principal balance. So if you look at two amortization schedules of a 15-year mortgage and a 30-year mortgage with the same loan amount and the same interest rate, the amount of money you pay every month to interest is going to be the same in the 15 and the 30 year. The only difference is that 15-year mortgage is forcing you to place more money every month to the lender so that you can pay down that balance quicker. But I always tell people, you never know what's going to happen with your employment. You never know what's going to happen with your health. So why handcuff yourself to a higher payment on a 15-year?
Right.
Take the 30-year and make the 15-year payments on it if you're that comfortable paying it off in 15 years. If something comes up and you can use that extra income to pay, medical bills, or, if you're furloughed and you're looking for a job, it's nice to be able to fall back on the lower payment of a 30-year. With that being said, however, if there is an incentive and interest rate where your lender might say, hey, you qualify for a 2.75 is your lowest rate on a 15 compared to a 3.25 on a 30-year, then based on your finances and your income situation, maybe it would make sense to take that 15-year just because you're getting it at a much lower interest rate than the 30-year.
Okay.
Yep.
Well,
Yep.
That was very well explained and kind of makes sense as
Right.
to what you'd want to do. Do you think it's a good idea for especially new homeowners to get pre-approved before they go out shopping, or pre-qualified?
So not only should you get pre-approved and pre-qualified before you own a home, or before you go home shopping to save yourself time, but you're also really saving time for your loan officers and your real estate people, because a ton of people want to go see homes. Oh my God, I really like this home. Let me go check it out. And they have no idea that, they have loans that might be in default, or, debts that they never closed out, and it's dragging their credit score down. So it's a terrific idea to not only get, pre-approved, but to get pre-qualified. And one of the biggest differences, when someone pre-approves you, they're gonna run your credit to check out your credit score, and that's gonna show your monthly debts. So they'll have your credit score, they'll have your monthly debts, and they'll say, hey, send me a pay stub so we can see how much income you have and to calculate what you're qualified for. But being pre-qualified, what I just described was the pre-approval. Being pre-qualified is not only checking your credit score and your income, but you go a step further when you pre-qualify, and you can say, okay, based off of the counties that you're looking for, this is the amount of insurance or the amount of taxes you're going to pay every year, and really get a definitive number of how much you're going to go ahead and qualify for. So the pre-approval, it's just kind of like the basic, credit score, income, debts. But when you're pre-qualified, a loan officer is going through, your credit report and saying, hey, not only do you qualify for a $200,000 mortgage, but if you pay off your Capital One card, for $1,400, you'd actually qualify for a $250,000 home. So the pre-qualification really is a more thorough look of your finances and where you can go from there.
Okay.
So
yeah.
Always get pre-qualified. Always get pre-qualified. It's sad when someone and sometimes I've had clients that you pre-qualify them, you pre-approve them. The mortgage process starts, and 20 days into the process, we get a notification that, there's been a bankruptcy that wasn't shown on their credit report, or there was an auto loan that was in default. A collections company might be coming after this person. So, if you've never really had a hard pull on your credit for a automobile, a card or a credit card. Sometimes, when you get your credit pulled, what it basically does is it sends out a signal to all these different financial companies with your social security card or social security number and date of birth. And then all these debt collectors are sending signals back and either saying thumbs up on this person or thumbs down. So, I've had people who I'll ask them on the phone, have you had any judgments, any bankruptcies, any liens? And, they'll just flat out blatantly lie and say, no, I haven't. And when we pull their credit, nothing is reporting on their credit. And we're thinking, awesome. But that credit report is in fact triggering, that credit pull is triggering all these other financial, these financial institutions to send a message back on Morse code saying, this borrower or, this client, whoever it may be, in fact, does have a bankruptcy, does have this debt. And that's just a messy situation because, people will say, oh, I had no idea about this, I'm going to dispute it. But, regardless, once that happens, you have to rerun someone's credit report and,
right.
Cross your fingers and hope that their credit score hasn't been damaged too bad. But, most of the times it's kind of a,
yeah.
Yeah.
Yeah, well, that's a lot of good info there. And now, would you, like, if you turn somebody down, would you let them know, hey, you need to clean up this debt and that debt, and then come back and see me in 6 months, or you need a little more for a down payment?
And that's one of the more difficult things to do,
Right.
As a loan officer. Sometimes telling someone, no, you don't qualify. I don't know what your bank teller told you or what your, cousin who's a realtor for 40 years told you. Looking at our guidelines and as a broker, I can tell on 99% of the files whether you do qualify or you don't qualify and how much for. So that's one of the, most difficult things is just sometimes telling people, hey, I'm sorry, you really have to do a better job of saving money, paying off, these debts, getting your credit score back up. And I'm not going to sound like a credit repair expert, but, some of the things that you can do to help your credit score is, don't max out your lines of debt. So if you have credit cards, don't try and, keep them at 90% of what, your max limit is on them. Keep them below 50%, pay off the higher balance loans first. And, little by little, you really can get your credit on track to owning a home. And sometimes, those are the most rewarding clients, even though it's difficult to tell someone, hey, no, I'm sorry, you have to wait another year, before you can qualify for a home. It's amazing when it comes around full circle and that person, has taken your advice and they do qualify. Some of the colleagues I have, we've gotten into pretty deep detail about this, and a lot of them are under the assumption that not everyone should be a homeowner.
Right.
Owning a home is a huge financial responsibility, as well, as a liability, right? So,
Right.
you have insurance, you're paying your taxes, and I think that's something that a lot of people don't really take into effect is, they'll be online on Zillow and it'll say estimated monthly payment $800, but they're not looking up, the city taxes and the property taxes.
Right.
They're not factoring in how much they're going to have to pay on insurance, and it's very, it's a very fine line. I mean, there's some brokers I know who work in this industry and they've always rented and never owned because, their school of thought is I'm better off, spending that money that I'm putting into my home, investing it in the stock market or investing it into the business. And, a lot of times these are people who live in areas like New York and San Francisco and Chicago, where owning a home isn't going to be a realistic option for them. Just because, 5% down on $1 million apartment is $50,000. And then that payment every month is going to be, $9,000 for them. And and they can't qualify for that. But I truly do think we are blessed. We're lucky. We're in a great state like Michigan where
Right.
you can find some steals out there for less than what you're paying in rent. So
Right.
it's just it totally is just a case by case scenario, and it's really hard to just have a universal answer for everyone, just because
Right.
humans are just different naturally.
Oh,
They're
definitely.
so peculiar and so unique.
Definitely. Um, and about that, the insurance and the taxes, I mean, if you're good with your finances, you probably don't need to escrow them. But could you
Right.
talk a little bit? What is escrow?
Escrow is your escrow account is an account that your lender has you pay into monthly if you brought 20%, less than 20% to closing, and that varies from lender to lender. So there's
Right.
some lenders where you can put 10% down and you can pay your taxes and insurance separately to your insurance agent and to the county. But there's other lenders where you need more of a down payment to waive their obligation of collecting extra money every month for on your behalf to pay your taxes and insurance. So if someone says you're going to need an escrow account, and again, if you're putting 3% or 5% down, almost always your lender is going to charge you whatever you're being charged for the financing, which again is your interest rate for your loan amount. But they're going to also charge you an additional 1/12, okay, because there's 12 months in a year, of your insurance premium amount annually and your taxes. So if you have a $12,000 tax bill annually, you're going to pay an extra $1,000 every month into escrow for your taxes, as well as if you have a $1,200 insurance policy, an extra $100 a month, and the lender holds on to that, and then the lender becomes responsible for paying your taxes and paying your
Okay.
homeowner's insurance when that bill is due.
Okay. Perfect. That's very good. Man, you've given us a lot of great info here. And
You're asking the great questions.
because a lot of those questions, I'm going to ask a selfish question
Sure.
because I like to do lease purchases, kind of rent to owns. If I give my tenant buyers rent credit, I know I can, take $100,000 house and say, oh, well, yeah, 5,000 in rent credit and to sell it to them for 95. And I know it depends upon the mortgage company. Do you allow them to apply that to their down payment instead? Or that's a tough one.
So if it's being applied to their down payment, you can always give them a concession, or
okay.
But as far as giving them a down payment, really the only time to have someone who's leasing receive a down payment is there needs to be a gift letter, and what a gift letter is let's say you don't have you don't have the amount that you need to put down towards a mortgage. You can get a letter that says, hey, I'm Yousif's grandma and I am going to give him $10,000, and it has to say in that gift letter that that money is a gift and it's not owed back to grandma. I don't have to pay grandma later for that money. And whenever you're gifting for a down payment, you need to put in that letter that this money doesn't need to be paid back. But that's actual funds that they need. As far as getting the rent credit towards the down payment, I mean, again, that's a lender to lender question, and I'll be honest with you. I would say probably not, but hey, you'd be surprised if certain certain lenders will say, yeah, we can do that as long as you can document that rental payment has been made on time. So a lot of times they'll say, okay, if this is going to get the deal done, we can do it for you, but you need to prove that these people make their payments on time to you all the time.
Right. And that's kind of how I present it to them is I just let them know that it will come off the purchase price. It'll be applied towards the purchase price,
right?
Because it depends on who they go with,
right?
Whether or not they would allow that. And that's the other thing is I only give them the rent credit if they pay it on the first of the month or prior to the first of the month. Otherwise, it doesn't count, and that
Right.
because they have to be disciplined with that. One last question, a tough
Sure.
one. Why would I want to work with you?
So you've had me as a student in your classroom, and I think, you know, anyone who's had a class with me will you know, they'll tell you Yousif's not afraid to speak his mind. And I think this is not really an industry for the lighthearted.
Right.
If you have an issue delivering bad news to people, or if you have an issue being direct and upfront with people, then you know, I think it'll be very difficult to be a loan officer. But more than anything, you know, I wanted to go and start my own company so I can be transparent and honest with people, and, you know, not work in that Wolf of Wall Street environment where, you know, it's, you know, sell them, or, you know, somebody else will, or, you know, buy or die. You know, I don't, you know, I don't really believe that, you know, that's what's going to create strong economies and a strong referral network. You know, the best gift you can receive as a mortgage broker is a referral. Someone that had a great experience with you and says to, you know, their brother or sister, you know, or a friend, hey, you really should give this guy a shot. So, you know, if you want someone who's going to be honest, upfront with you, you know, and one specific person, one sole person working on your file, I'm going to be that guy for you. You know, through the thick and through the thin. I mean, you know, whatever happens, you know, I'm going to be there with you. And you know, I don't like to admit it, but, you know, I am next to this guy, like, you know, like a baby with a pacifier. I mean, you know, it's constantly in my hand, it's constantly in my mouth, you know, and, you know, I'm here. I don't believe in taking, you know, a day off when you want to pursue greatness. I don't believe in, hey, you know, I'm out of the office Friday. Please call me Monday. You know, when it comes to mortgages and when it comes to money and when it comes to investment of this size, you know, you truly need someone around the clock that's always willing to, you know, be there for you. So if you want someone honest, you want someone who's going to, you know, work hard on your behalf, then, you know, please, Phoenix Mortgage, Yousif Oraha, give me a call, give me an email. You know, I'm on Facebook, on Google, just look me up, and, I'll, you know, I always say I'll write the loan, or I will help you as if you were my own brother or sister. And, you know, that's the difference. If you come here, I'm going to treat you like another family member, because that's the only way you're going to say good things about me.
Definitely. And I will, from my own experience with Yousif, I will give you three things: honesty, integrity, and transparency. He's the guy you want to work with. Again, Yousif's information is there on the screen, and it's also in the description below. Yousif Oraha with Phoenix Mortgage. We appreciate you coming on today, and looking forward to doing more